Ladies and gentlemen, welcome to this week's version of Nichols and Dimes, our weekly video series. The quote of the week this week comes from, of course, Warren Buffett, who recently said that he was talking about bond investors, and he said bond investors face a bleak future. Bond investors face a bleak future. Well, why would Warren Buffett say that? Well, he's specifically referring to the inverse correlation between bond values and interest rates. Now, back in the early 80s when interest rates, remember back then when interest rates were in the low to mid-teens, you could invest in a CD or money market, and even the 10-year treasury, you can get 11, 12, 15, and, sometimes a little higher coupon. So now, obviously, rates are at historic lows. They've been like that for years and years and years. And Warren Buffett says, hey, when interest rates start going up, which they have been most recently, bond values are going to move down. And that's not a new subject. I mean, most people know that interest rates and bond values are inversely related. But what we've seen over the last few months is the 10-year treasury yield, which late last year was lower than 1%, was less than 1%. It's moved up to around 1.5% quite quickly. And the concern is you see a lot of downward pressure on the bond market. So Warren Buffett is could potentially be right, and with his concern, if you will, for bond investors. There's some thought process that a lot of bond investors, if they can get a 2% yield on something as at least theoretically safe as a U.S. Treasury, they may get out of the equity markets, and because the average S&P 500 stocks dividend is around 2%. So the thought process is, well, if I can get a 2% yield in large cap stock on average, well, you know what? With a lot less risk, i.e. the U.S. Treasury market, I can get the same 2% yield. So again, that's the thought process. So we are seeing some volatility in the stock and bond market because of the 10-year treasury. So bottom line is this. So if you do have bonds, be careful. If you are going to invest in bonds, invest in a short intermediate term bond so that you're not crushed, if you will, because long bonds, which tend to yield a bit higher than short and intermediate term bonds, the principal value is probably going to get compromised, of course, to the downside. To that end, if you would like a second opinion on your bond portfolio, if you're not sure about how rising interest rates affect you, you are welcome to send us an email, cnichols@nicholswealth.com, or go on our website at nicholswealth.com, click on the services tab, click on second opinion service, and you reach out to us and one of our advisors will contact you. Thank you again for watching. I hope you liked this video of me driving in the car, and I have my seatbelt on, and don't worry, I'm driving safe. Thanks again for watching. Bye-bye.